Hazelview Investments has just released a report which says that there are significant opportunities in global real estate investment trusts and that they are set for decade-high valuations. For a deeper dive into this report, we're joined by Corrado Russo, Managing Partner and Chief Investment Officer at Hazelview Investments. Thanks for being with us, Corrado.
Happy to be here.
Now, overall, would you say one of the main risks, if not the biggest risk for REITs right now, are these escalating bond yields? Would you agree with that or not necessarily?
I think it's certainly something for us to watch. I think that's frankly why the performance has been what it is. I think, a lot of volatility in the bond yields and how they've been moving has led to a correction in the REIT market. And in fact, if you look at where REITs are, whether it's the US or Canada or globally, effectively we've given back all of the gains that we got from the sort of central bank pivots of 2024, and we're kind of back to the levels before we saw that pivot. So I would challenge that statement to say that the recent movement in bond yields has sort of given us another very attractive entry point for REITs, going forward into 2025.
So, Corrado, how would you assess and describe the fundamentals generally of the global REIT sector?
Well, I think that's probably what's less understood in the REIT sector. The fundamentals have been very, very strong. If we look at demand has continued to be quite attractive outside of office, for example. I mean, there's lots of news around, office space, and that continues to be a little more challenged space that we're seeing some green shoots. But when you look at apartments, industrial, self-storage, and some of the specialty sectors like data centers, cell towers, healthcare, or senior housing, fundamentals are as strong as they've ever been. Demand continues to be very strong and growing, and that's leading to ongoing occupancy and higher rent. But even more so on the fundamental side, supply is one of the lowest levels we've ever seen. Obviously, given COVID and then the higher interest rates, it's made it very difficult to develop new assets in many of these sectors. So that's meaning that we're starting to see a shortage of supply come on the market. So as demand continues to grow, you're going to have a situation where you're outstripping supply, and that generally leads to higher occupancy and higher rents, which ultimately leads to higher cash flow growth.
Now, you've touched on this, I believe, a little bit, but you're saying that valuations are the best in decades. Can you elaborate on that?
Yeah, so if you look at where, it doesn't matter what metric you look at the discounts that REITs trade at versus general equities, given how much general equities have moved, driven by the tech sector, they're the lowest they've been in a couple decades. If you look at a price to cash flow basis, for example. If you look at the discounts to private real estate, they're as low as they've been since the financial crisis. If you look at the multiples versus the historical average, they're lower to, relative to their own average. So when we look at where the entry point from a valuation perspective is today, we're seeing levels that we haven't seen in a couple of decades. And so what's really interesting to me is you've got this combination of growing earnings and strong fundamentals, but a very low entry point in terms of valuations that we haven't seen in quite some time.
All right, let's get to some of your themes for this year in terms of where investors may consider investing, the types of REITs. So starting with data centers, that is a hot term, of course, because of AI. And anytime you want to sprinkle in a name or two, if you like, we'd be happy to hear those. But start with data centers, if you could, please.
Yeah, the data centers is one of the areas that we would sort of highlight as having exploding demand, obviously through the hyperscale tenants like Google, Amazon, Meta. To us, it's kind of a much cheaper way to invest in the opportunity that we're seeing in AI. You obviously seen what's happened to the valuation and growth of many of the tenants for data centers. But you look at, as they grow their AI capabilities, they're going to require a lot more equipment, and that equipment requires so much power and so much cooling and redundancy that it has to be housed in data centers. And so that's creating, record low vacancies, which we expect to persist across the US markets like Northern Virginia, Phoenix, Dallas, for example. And this is expected to create a long, sort of tailwind of growth for this industry And when we look at the underlying supply, that seems to be working its way through the system. So we anticipate to see a sector in data centers. For example, one of the names that we like is Digital Realty in the US. One of our favorite names is Sunny Vision out of Hong Kong. These are two of the prime markets that prime players that not only have great positioning relative to the tenant base that's growing their AI capabilities, but they also control much of the new supply that's coming on. So they are building these new hyperscale centers, which they expect to add to the bottom line over the next 3 to 5 years.
And then, Corrado, seniors housing would appear to be a demographic play. What more can you tell us? You're talking about the Chartwells of the world?
Yeah, I think this is probably one of the strongest demographic tailwinds that we see across all sectors within real estate. We've been talking about an aging population for many years now, if not decades. But the aging population, the aging baby boomers is here. It's continuing to grow. The cohort of 65 plus is expected to be amongst the fastest growing population segment in Canada and the US. And if you look at 85 plus, it's even faster. And if you look at the supply, we have historically had too much supply prior to COVID, and that sort of kept rents in check. And even though we were having demand from aging population, it didn't really translate into significant earnings growth. What's changed is since COVID, there's been very little supply, if any at all. And that's creating a dynamic where you've got a shortage of senior housing, a shortage of quality senior housing, and a lot of these existing buildings are becoming obsolete. So those that have high quality properties or are delivering, good properties to the market over the next couple of years are expected to see significant increase in earnings and cash flow. So we think this is one of the, strongest tailwinds in the real estate sector over the next 5 years.